Professional traders at proprietary trading firms and funds often seek consistent returns by selling volatility. One of the most popular strategies in these contexts is the iron condor, which involves simultaneously selling a call spread and a put spread on the same underlying. For instance, a trader may execute an iron condor on the S&P 500 index with strikes set outside a tight range. If the index stays within the range by expiration, the trader pockets the net premium as profit. This strategy is widely used in neutral markets where the goal is to profit from time decay and stable prices. Why use advanced option strategies? Advanced strategies allow traders to profit from volatility or lack thereof, reduce cost of directional bets, create defined risk setups, and capitalize on time decay and range-bound markets. Buy a lower strike call and sell a higher strike call. This is a net debit strategy with capped upside. Bear put spread payoff structure. Buy a higher strike put and sell a lower strike put. This structure profits from a moderate drop in price. Why use them? They offer lower cost than outright options and defined risk and reward. Straddle payoff structure. Buy a call and a put at the same strike and expiration. This strategy comes at a high cost but offers unlimited profit in either direction. Strangle payoff structure. Buy a call and a put at different strikes with the same expiration. It is cheaper than a straddle but requires a larger move. Use cases include earnings announcements, central bank decisions, and major news or volatility spikes. Structure. Sell an out-of-the-money call spread and sell an out-of-the-money put spread. Goal profit if the underlying remains in a defined range. Maximum profit, net premium received if all options expire worthless. Maximum loss, the difference between strikes minus net premium received. Best use, low volatility, range-bound environments where time decay, also known as theta, works in your favor. All advanced strategies must be sized according to volatility. Margin requirements differ based on net exposure. Rapid moves near expiry can cause gamma risk, especially in spreads. Selling spreads always carries defined but non-negligible risk. Monitoring Greeks like theta for time decay, vega for volatility, and gamma for the rate of delta change is key to managing multi-leg positions. These strategies give traders more precise ways to profit in various market conditions. Bull and bear spreads manage directional bets with lower cost. Straddles and strangles aim to capture big moves from volatility. The iron condor is best when expecting stable prices, offering income with controlled risk. These strategies give traders more precise ways to profit in various market conditions.